What if I told you that the entire modern financial system operates exactly like an unbreakable law of physical science, where every single action requires an equal and opposite reaction, and making a single mistake leaves a mathematical hole you cannot hide? Welcome to Money's Hidden Past, Rich People Lied. We fact-checked today. We are stripping down the absolute core of corporate accounting to expose exactly how billionaires track their wealth and hide their crimes. If you want to understand how the global economy truly functions, you have to stop looking at the massive glass skyscrapers and start looking at the quiet mathematical ledgers operating inside them. Because every single corporate empire is built on a single equation. Before the late 15th century, business accounting was incredibly primitive. Merchants essentially kept a running diary of their daily physical transactions, writing down what they sold and what they spent in a simple list, a rudimentary system known historically as single-entry bookkeeping. This diary method works perfectly fine. If you run a small bakery, you count the coins in your wooden register at the end of the day. And if you have more than you started with, you made a profit, but a diary is entirely useless. If you're running a global empire, if you sent a wooden ship loaded with silk to trade in a distant port, and the captain returned, claiming he lost half the cargo in a terrible storm, a single-entry diary offered absolutely zero mathematical way to prove he was lying, leaving the business owners completely vulnerable to endless internal theft. If you're trading across different sovereign countries and foreign currencies, a simple list cannot tell you what your total business is actually worth. It cannot accurately track what you owe or what your inventory is valued at. And worst of all, it is incredibly easy for an employee to forge the solution. It came from the brilliant mathematicians of the Italian Renaissance, who realized that wealth is almost never actually created or destroyed. It simply changes shape and moves from one category to another, and to track that movement, you have to record every transaction twice. This is the foundational concept of double entry. Bookkeeping, a system organized completely around one fundamental accounting equation. Your total assets must always equal your liabilities, plus your equity, meaning what you own equals what you owe, plus what belongs to you. Your assets represent the physical tools and liquid capital you have weaponized. Your liabilities represent the exact heavy burden of debt dragging your company down, and your equity is the true underlying value that you actually get to keep the ultimate number that determines if you are building an empire or going bankrupt. This equation acts as an absolute mathematical tether for your business. Whether you are buying a cup of coffee or acquiring a rival corporation, the dual-sided nature of the ledger forces the math to perfectly balance, leaving a verifiable paper trail for every single cent that moves to visualize how this physical balancing act actually plays out. Imagine you're launching a brand new historical documentary series, and you take $2,000 in cash to buy new camera equipment. In the old diary system, you would simply write down an expense. But in the double entry system, your total wealth has not changed. The physical cash in your business account decreases by $2,000, while your physical equipment account increases by $2,000. The wealth simply changed its physical shape from paper money into glass lenses. The paper cash is gone, but the purchasing power remains perfectly trapped, locked inside the metal and glass of the physical production equipment, ready to be actively deployed to generate future value for the corporation, without artificially altering the fundamental baseline worth of the operation, because you are forced by the system to record the transaction in two places. The total mathematical value of your assets remains exactly the same. Your ledger stays perfectly balanced across the accounting equation, and you maintain total accurate visibility over your operational resources. But what happens when you bring entirely new outside money into the system? Imagine you decide to aggressively scale up your video production company, and you take out a $10,000 business loan from a local bank to cover the upcoming costs of historical research and professional editing. When the bank deposits those funds, your cash account increases immediately. This is officially called a debit because your total assets are going up. But simultaneously, your bank loan account also increases by $10,000, which is a credit because your total business liabilities are going up. Your assets increased by exactly the same amount as your liabilities, meaning the two sides of the fundamental equation match perfectly. The books balance and tell you a very clear and undeniable story. You have cash to spend, but that specific cash belongs to the bank. Now imagine you take $500 of that borrowed cash and you pay a freelance graphic designer to create custom digital thumbnails. Unlike a camera lens, a freelance service is an immediate operational expense. It is consumed the exact moment the transaction is completely finalized. Your cash asset account decreases by exactly $500. But because you bought a service that holds no permanent physical value, the overall fundamental worth of your entire company takes a direct hit, meaning your corporate equity account must also decrease by $500. Both sides of the mathematical equal sign shrink in total harmony. The assets drop, And the equity drops, keeping the entire ledger secure. This guarantees that your operational burn rate is properly documented, preventing you from foolishly thinking you have more value than you do. Now let us assume those custom thumbnails perform exactly as intended. The click-through rate spikes and the video goes completely viral online, generating exactly $1,000 in advertising revenue from the platform. This is new money generated entirely by your operational business model. When that $1,000 hits your bank, your cash asset account increases. And because your business actively generated brand new external wealth, your corporate equity account also increases by $1,000, growing both sides of the master ledger and keeping the math totally balanced. If you step back and look at the mathematical story your books are telling, you can see that you are currently highly liquid with cash on hand. You're heavily leveraged because you still owe the bank their $10,000, and you're profitable because your equity grew by $500. This level of deep operational insight was impossible before the Renaissance. And it was made possible by introducing a concept called the T account. If you imagine a large letter drawn down the center of a blank page, every single financial category in your company gets its own separate letter. The left side of the vertical line is always referred to as the debit, and the right side of the vertical line is always called the credit. The brilliance of the system lies in the unbreakable rule of movement. An entry on the left side always requires a matching entry on the right because every transaction forces a left debit and a right credit. The total sum of all the left sides across your entire corporate empire must always exactly equal the total sum of all the right sides, creating an ultimate structural lie detector for the financial executives. At the end of every month, the accountants run a massive trial balance. They add up millions of debits and millions of individual credits. If the two final numbers match perfectly, the books are completely clean, but if the left side is missing even a single dollar, everything stops. Accountants would spend hours locked in quiet rooms with heavy paper ledgers, manually tracing every single line of ink, looking for the single accounting error, knowing that the business could not move forward until the math was corrected. A beautiful and frustrating system that forced absolute corporate accountability. That missing dollar proves that a mathematical error has occurred or that someone inside the company is actively stealing physical cash. The system makes it mathematically impossible to simply erase money because erasing a debit leaves a highly visible hole on the credit side. This level of verifiable financial trust is what allowed banking to flourish, funding massive global trade and the rapid expansion of physical empires. But because the double entry system is essentially an unbreakable law, it creates a fascinating logistical problem for modern corporate criminals. How do you lie to your investors? When the math always has to balance, the answer lies in the ultimate destination of the individual. Accounts a single high contrast document officially known as the balance sheet, which is a complete snapshot of the fundamental equation. In real time, to hide massive financial rot or project an illusion of spectacular wealth, executives cannot simply erase numbers because the lie detector would catch it. Instead, they must maliciously manipulate the classification of the numbers, fabricating the reality underneath while keeping the core math balanced. There are three classic illusions used to orchestrate economic collapses. The first is the creation of a phantom asset to artificially inflate value. If you want your corporate equity to look massive without doing any actual work, you have to create a fake asset out of completely thin air to balance it. This was the exact strategy used in the infamous Bre-X mining scandal. The company publicly claimed they discovered a monumental untapped gold reserve deep inside an uncharted jungle completely isolated from outside inspectors, allowing them to instantly debit $5 billion to an unverified asset account to balance the equation. They credited their equity by $5 billion. The books balanced perfectly, and the strict mathematical rules were followed. The only problem was that the jungle asset was literally just plain dirt, and when the illusion shattered, it wiped out institutional wealth in a single day. The second major illusion is the malicious capitalization of operational expenses. We already established that spending cash on daily operations shrinks your equity. So if a massive company is bleeding cash and wants to hide the devastating loss, they reclassify the spent money using a highly deceptive accounting trick. This was the devastating strategy utilized by the telecommunications giant WorldCom. Instead of recording their routine daily server maintenance as an actual expense, they falsely claimed the maintenance was a permanent upgrade to their infrastructure, reclassifying the spent cash as a long-term physical asset on the balance sheet. The physical reality was that the cash went down and the equity should have dropped, but the mathematical illusion kept the total assets looking perfectly identical, falsely protecting the company equity from taking a massive public hit and keeping the investors completely blind to the fact the company was dying. The third and perhaps most destructive illusion is the black box debt manipulation. If your company is aggressively drowning in massive unpayable liabilities, your total equity will be mathematically crushed, and your stock will plummet. So the executives simply moved the debt accounts entirely off their own ledger. This was the primary architectural fraud engineered by the energy giant Enron. The executives created entirely separate unlisted corporate shell companies, which were quietly referred to as special purpose entities in the boardroom, and they violently transferred their massive toxic debts onto the shell ledgers. Suddenly, the primary public balance sheet showed drastically dropping liabilities, and the company equity appeared to be soaring to absolute historic highs. The math on their public reporting document was technically and legally balanced, but the toxic debt was simply hiding in the dark, waiting to eventually detonate. When the Enron shell companies inevitably collapsed under the weight of the lies, the toxic debt rushed violently back onto the primary corporate balance sheet, completely wiping out the retirement savings of thousands of hardworking employees and permanently destroying one of the largest accounting firms on the planet. The pure genius of the double-entry bookkeeping system is absolute transparency. It transforms business from a complete guessing game into verifiable physics, proving that every single financial action has an equal and opposite reaction, and forcing the executives to physically account for every operational decision, whether you are a 15th century spice merchant sailing the Mediterranean or a modern video creator trying to scale a digital financial history channel. Your entire operational survival rests on the balancing act of the ledger, the silent mathematical logic that dictates who succeeds and who goes bankrupt. We are constantly told to trust the brilliant visionaries running the economy, but the visionaries are absolutely nothing without the quiet math. Keeping them honest, the numbers strip away the corporate marketing and expose the undeniable truth, showing you exactly who is building value and who is merely shifting numbers around the system, acts as a permanent structural safeguard against total financial chaos, forcing corporate fraudsters to invent incredibly complex and fragile illusions. Just to bypass the simple mathematical rules written down by a wandering monk, proving that numbers are the only language that cannot be easily silenced if this deep dive into the unbreakable laws of double-entry bookkeeping and the sophisticated illusions used to orchestrate corporate fraud fired you up about understanding the literal mathematical foundation of the global economy, then do me a massive favor. Right now, smash that like button to let the algorithm know this factual historical conversation matters. Share this video with every friend and family member who needs to understand how the real financial world operates. Let us keep exposing the true mechanics of wealth and power. I will catch you in the next one, where we break down the next hidden chapter in the long history of money and corporate authority. Until then, stay informed, stay skeptical, and remember that sometimes the biggest lies in the modern financial world are hiding directly behind a perfectly balanced mathematical equation.